I'm Franco Bruni, the lead co-chair of Task Force 9 of the T20. Welcome to this panel of the Global Solution Summit, which is devoted to the themes of our task force and international finance, and in particular to the short and long-term challenges posed by the international financial system in distress. The work of Task Force 9, where I act as a co-chair, is centered on 15 policy briefs that we have selected among the many more that have been submitted as abstracts. The briefs address the challenges on several specific fronts, proposing research-based policy measures that the G20 should take into consideration in its deliberations. In particular, the themes addressed are the debt problem of less developed countries, the elements of the global financial safety net available to cope with short-term liquidity needs of those countries that have been hit by strong liquidity shocks during the pandemic, the challenges posed by climate issues, by the digital transition, and by the ESG targets to monetary and financial policies, the macro policies required to successfully exit from the extraordinary monetary and financial stimulus of the past years, the regulation of multinational state-owned enterprises. Several of the conclusions and proposals of the various policy briefs are obviously interconnected and form a network of policy suggestions that address the most urgent problems of the international financial system. All the policy briefs suggestions are aimed at the core of the current global economic issues, which characterizes the whole spirit of this global solution summit, the need of recoupling economic growth and measurable economic welfare with deeper and more general welfare targets that global cooperation should consider in its policy deliberations. Some of the panelists are authors of some of the policy briefs that address these themes. Some of them are also co-chairs of the task force. I will first ask them to briefly talk about their work and synthesize the proposals they are making to the G20. An experienced economist and policymaker will then add his comments and views. Let me start by giving the floor to Alicia García-Herrero from Bruegel and Natixis, whose policy brief deals with the global debt problem and proposes a new fund for the world economic recovery. Alicia.
Thank you, Bruno. It's a pleasure to be with you all. I'm going to be brief and introduce you to a policy idea designed to mitigate one of the most important scars that will remain with us once we get out of COVID, and that's going to be the unsustainable prospects for debt dynamics in the emerging and developing world. What we've done so far, and of course it's encouraging but not sufficient, is at the G20 level, basically a delay of debt service up to the end of this year under the DSSI initiative. But things will get much worse as we enter 2022 with probably much lower growth than expected in many of the emerging economies and possibly even tapering by the Fed. So just imagine what that might mean in terms of cost of funding. Because we believe that no matter the good intentions, the IMF programs won't be enough to solve debt issues. Not all of the problems are liquidity only. And even for those, there might not be enough resources at the IMF level, we propose to create a debt recovery fund. The best way to describe what we intend with this new fund is to think of the European Financial Stability Facility. It's basically a fund which relies on the guarantees of existing creditors. You can think of the large variety of official creditors we have in today compared to the past, China being outstandingly larger than the whole Paris Club together. So we would have China, the rest of the Paris Club, and this is important to note others that may be interested in global financial stability, and in particular in having the developing world use their debt for better, quote unquote, purposes, meaning for either climate change or even avoiding global health issues, pandemics, etc. So in that regard, we would expect the fund to have a good variety of high rating creditors to be able to lend to existing developing economies, swap their debt at a lower cost. That's in essence what our proposal intends. Of course, to do so, we would rely not only on debt sustainability analysis by the IMF, but most importantly, on collateral by those countries that want to swap their debt. So that's basically, in a nutshell, the proposal. It requires some institutional thinking, how countries, creditor countries, are going to agree to do that, and how then they're going to look for the funding on their liability side of this fund to then be able to swap existing debt. We do think that such endeavor, whether it's this fund or any other interesting proposal, is actually urgent for the reasons I mentioned already. Capital flows into the emerging world are coming down, are much lower than they were. And again, as I was saying, we're all expecting the Fed at some point in time to increase the cost of funding for the world. And that's going to be a shocking moment. Thus, we should be ready for that. And I leave it here. Thank you very much.
Thank you, Alicia. So this is the debt problem. Let's go to a different one, which is how to deal with the ESG targets, environment, social, and government subject. Claude Lopez from Milken Institute has been addressing this complex issue, which is also an important issue for the financial sector in the world. Claude.
Thank you, Franco. So as you said, you talk about ESG target, and actually that's very much the core of the piece that we wrote with Jose. Because as of now, whenever you talk about ESG, it's ESG investing. And so there is a lot of interest. You see that more and more investors are aware of issues that are relevant and that are non-financial, social unrest, or even recently the pandemic shows that whenever you want to assess the resilience of a company, you need to go beyond just the financial aspect of that company. Unfortunately, as of today, there is, while there is a push for more and more of that investment, there is big difficulty in terms of assessing really, truly what are the performance of companies whenever it comes to ESG, because there is strictly no standardization, no agreement of the definition of really what ESG investing is. And so how to achieve that. So far, most of the assessment or ratings that you see usually are aware of assess whether or not a company does something in that direction, but there is no notion of progress toward achieving the goal, because most of the time whenever we talk about ESG investing, we talk about impact investing too. And so to have an impact, they need to be specific targets. In this report, what we suggest is going beyond what is being discussed in many different places right now regarding standardization, is how to achieve and what standardization means. So first, it will be to really identify what are we trying to achieve, what are the goals of this ESG investing. So what are the risks? And really agree on among the big diversity of ESG risks that there is out there, that we really want a company to, or company want to show more resilience to. Number two, identify what are the different policies that would allow to achieve those goals. Number three, to identify the variables that would allow monitoring. And that's really where, whenever we talk about assessment, where the standardization really kick in, because besides just collecting information, and standardization would make things much easier also for firm to know what is expecting from them and where to improve. It would also benefit the investors because they would see that there is some commonality regarding the information that is being collected and compare and being able to compare it from one company to another. And finally, the fourth point, because most of those evaluations rely on ratings, and so that's been by third parties agencies. We also emphasize that they need to be transparency. While you can have similar variables, is how you will aggregate it that will actually do the final assessment, and that assessment may vary depending on the methodology or depending on the priorities of each rating agencies. Diversity of methodology is really not a problem. It's actually very beneficial for investors because that will allow them to tailor the information or to select the information they want to use based on their priorities, but they need to fully understand what are the different priorities or focus of the ratings they will be using. Same thing for the company, understanding how they are being assessed will allow them to implement the right policy to achieve that goal. Finally, what do we think that the G20 is very much a platform where some of that discussion should happen, is that the same way that it did for the financial stability and Basel III, the G20 is the right platform to start discussion where we need to have collaboration among developed and less developed countries, private and public sector in all those entities. For that framework, and so this technical standard to be implementable, you need to have regulators, but you also need to have the companies that are going to be evaluated as well as the investors in that discussion. The framework will be implementable. I think I'm going to stop here.
Thank you. So let's now go to another of the themes that we have picked for this panel and that have been chosen among the many more that our task force is caring about. And the floor is with Jose Siaba Serrate from CARI, Buenos Aires, co-chair of the task force, whose contribution deal with Claude's ESG theme and with the challenges of the digital transition. So I think that this is going to be the theme he will talk about. Yes.
Thank you, Franco. Our policy brief, we wrote it with Claude, is on the emergence of new monies and the need to prepare the financial system for the digital age. If you check in the last 10 days, two important authorities have mentioned this topic. One was Jay Powell on May the 20th. He said that the Federal Reserve is studying these developments and exploring ways that it might refine its role as a core payment services provider and as the issuing authority for the US currency. And the other speech some days before was from Gail Brainerd, who's the governor of the Fed. It was titled Private Money and Central Bank Money as Payments Go Digital, an update on CBDCs, which is very much quite our topic, even though our scope, I would say, is broader. But what Brainerd says is that with technology platforms introducing digital private money into the US payment system, and with foreign authorities exploring the potential for CBDCs in cross-border payments, with those two elements in place, the Federal Reserve is stepping up its research and public engagement on CBDCs. And Jay Powell has said that in the summer, the Fed will publish a discussion paper on the subject. So there's a long tradition of benign neglect in the US about its currency and its international role. That neglect has been put aside because of a phenomenon occurring outside the US, which is now very important. And we stress that topic to suggest this specific proposal to the G20 leaders. We urge them to develop a comprehensive vision on the future on money and payments, and to develop continuing monitoring on these topics, which is what the Fed is saying they will do. And keep in mind, the Fed was the less enthusiastic central bank to tackle these issues, but it was forced in a sense because things are getting developed with or without the surveillance or the leadership of central banks. The second point, once you have developed a vision, is to integrate that vision into an agenda, practical agenda. And the task of that agenda is to guide a resilient financial system in a prudent transition towards the digital age. it's not monies, it's not payment systems, it's credit creation, everything. The whole financial system is in the middle of a process where technological change stands out as a more visible element. But I would say that social change is more powerful indeed. And at the end of the day, central banks' duties are to serve the public and provide them safe payment systems in the way the public prefers. And preferences and tastes of the public will change, not only because of technological change, but mostly because of changes in the society. The third point of our proposal is to encourage the broadest international cooperation. And we are sure that cooperation will appear because everyone, even the Fed, feels the challenge of this topic going ahead. In this sense, you cannot forget that central banks do not want to commit a mistake here. They might afford to be late, but they want to be in having the right ideas by the time these might be actionable or clear a need for public policy. The fourth point is that the world needs a global digital governance compact, and you need it for financial reasons, but you need it more because digitalization is affecting the whole society, and the new players in the finance field might come not from the traditional players, but from big data platforms like Amazon, Facebook, etc., which are way bigger, which grow faster, and which have huge financial muscle, well above what the big banks, which are deemed too big to fail, carry. So 7 of the 8 biggest corporations in the world now are from that family of lightly taxed, lightly regulated, and overseen data platforms companies. Then we add 2 other important things that are already in place. The G20 should continue execution of the G20 roadmap for cross-border transactions and supporting the Global Partnership for Financial Inclusion and implementing its G20 Financial Inclusion Action Plan. Financial inclusion and cross-border transactions are 2, I would say, lower-hanging fruit that digitalization can achieve with successful outcomes in the very short term. To make this proposal operable, we think the G20 has to set up a digital money and finance working group to perform the analysis, the technical analysis of new digital instruments and innovations, propose the framework for their incorporation to improve the financial architecture and society's welfare, and monitor implementation, always keeping in mind that the priority should be addressing financial stability risks, which in the transition might be huge. I will leave it here.
Thank you. Another topic, another panelist. The floor is now with Akshay Mathur of the Indian think tank ORF, who contributes to the task force an interesting brief on the needed regulation of state-owned enterprises. Akshay.
Thank you very much, Franco. My pursuit has been to look at how state-owned multinational enterprises can be regulated. As we all know, we are very familiar with state-owned enterprises. Typically, and especially in the recent history, state-owned enterprises have been associated more with China because it has over 600,000 state-owned enterprises at national and subnational levels. But the state-owned enterprises are present everywhere, in developed countries and developing countries, Germany, France, Korea, India, besides China. So it's across the board. And state-owned enterprises also span across all industries. So banking is an industry where, of course, many banks are public sector owned or supported, but also infrastructure is another area, extractive industries another area. So state-owned enterprises are fairly widespread. And one of the IMF studies had reported that the collective worth of state-owned enterprises is close to 47 trillion, and their estimated debt is over $7 trillion. So their systemic impact on the global economy is potentially huge. My area of study is actually even one part of the state-owned enterprises, which is the state-owned multinational enterprises. Because if we take out the subnational and local enterprises and focus only on the multinational enterprises, the state-owned multinational enterprises, just to see what kind of systemic risk they pose, what are some of the trans-border investments they have, and how do we need to regulate them? And if we start to look at what policies, what global regulations we have for state-owned multinational enterprises, we find that there aren't too many guiding principles. Now, of course, there is some headway that has been made for state-owned enterprises. That also needs work to be done, but still, G20 has some guiding principles, OECD has some guiding principles, IMF has some work for state-owned enterprises. So whatever we think of state-owned multinational enterprises, we can build on what work has already happened for SOEs. One of the shortcomings of two shortcomings of the framework that we currently have for SOEs is this. Most of the guiding principles and regulations focus either on anti-corruption and governance related issues, which is how the state-owned enterprises should deal with the firms and how they should deal with whistleblowers, etc. Or they try and deal with debt transparency, how much debt they have and whether they can take on more borrowing. When we start looking at state-owned multinational enterprises, I think we can cover these gaps that we have for SOEs and add a few extra regulations. So let's look at two areas in which we can impose or craft some regulations. The first is definition. We don't have a very good definition for state-owned multinational enterprise. We barely have a good definition for state-owned enterprise. IMF has one definition for state-owned enterprise. It speaks to whether the government controls the majority share, can it control the majority voting share, etc. So for state-owned multinational enterprise, I think we can add a few elements in there to have a proper definition. The second area is data disclosure. And this is particularly key because for state-owned multinational enterprises, we really want to know what their foreign acquisition investments are and where they're receiving foreign funds from. So those are the two areas in which we have a global framework, and I think G20 is particularly well placed to provide this framework and maybe even assign an institution like the IMF, maybe, to monitor this and to develop this framework and monitor going forward. I'll stop here.
Thank you, Akshay. Well, we have the privilege to have another panelist who is not member of our task force. It's Mehmet Şimşek from Dome Group, a former Deputy Prime Minister of Turkey. And we start thanking him for his comments on the topic. Thank you.
Thank you, Chair. Let me express my appreciation and, congratulate the Global Solutions team for putting together yet another successful event, hopefully. I also would like to thank all my fellow panelists for their insightful and really great solutions to some of the problems we face. We know that policymakers are not on our call, but let's hope that later on they take note and act on some of these recommendations. I've been attending such events for decades, we've discussed a lot of issues, in particular substantial macroeconomic issues that have substantial macroeconomic impacts, inequalities, climate change, aging populations, of course, rising debt burden, but rarely G20 acts on these issues. I've been there since the beginning, both as minister representing Turkey throughout both ministerial level meetings and leaders meeting. But I think it's very, very important that we continue to address some of these, discuss these challenges and address them. Let's face it, ignoring the problems are very costly. Prior to COVID outbreak, probably there were thousands of scholarly articles or conferences where, policymakers were urged to, put together contingency plans, capacity building, etc. But we've seen that not much was done, and therefore we had to spend a lot of money, massive fiscal deficits. Even in developed world, we realized that the capacity wasn't there. If I may, I'd like to make an extra, after this general observation, I'd like to make three observations about macro challenges in the near term. First of all, central banks have done a really great job in engineering a V-shaped recovery. Growth is now above trend in many developed countries, or is getting there. I know there is divergent growth story, EMs are lagging, but that's what's important. So interest rates are very low, growth is there, but it's unlikely to be sustained simply because we now have a situation where inflation and inflation expectations are rising. Now, markets, because they're flooded with liquidity, they are willing to take central banks' narratives that this is a temporary, the inflationary pressures are temporary. Markets wants to take that at face value. But the reality is, if inflation pressures prove to be more resilient or bigger issue, then I think we may face some significant problems down the road. Let me just give you a simple example. Roughly a year ago, investors who bought Austria's 100-year bonds when they were sold roughly a year ago, now face a loss of more than 30%. Imagine, pension funds that have invested in this. So only a few months ago, negative yielding stock of global bonds amounted to over $17 trillion. So I think central banks need to start thinking about asset bubbles that they create, impact of quantitative easing on inequalities. But also more importantly, in my view, the fact that there are easy fix and quick fixes, it prevents policymakers from really focusing on underlying problems, root causes, and coming up with structural solutions. So that's really what worries me. So that's my first point. My second point relates to, it actually adds to what Claudia said, is while we have global growth that is very, very strong now, but outlook for emerging markets isn't so bright. In fact, if you look at ex-China and maybe India temporarily, EMs have no longer been outperforming developed markets, meaning there's no more real convergence. What does this mean? It means capital inflows are no longer strong, but many emerging markets are still running large current account deficits. What does this mean? It means you need financing. If you don't get it, you're likely to face with more frequent and large currency corrections. Now, emerging markets are now more than 50% of global GDP. Therefore, I think it's important that G20 focuses on how we manage divergent recoveries. In my view, focus along with a fund or strengthening IMF would be on better fiscal policies and structural policies that would address low productivity in some of these countries. My final point is there appears to be a big shift, even in mature developed economies, in economic policy, which can be summarized as a large, fiscal deficits monetized by central banks, meaning the old thinking was that markets best suited to solve problems. The new thinking is, well, government intervention really helps. Central banks do a great job, and investments by government pays back handsomely. The reality is debt and deficit still matters. Somebody has to pay for it. Even in mature markets, zombification, meaning zombie companies that are unable to service their debt, make up nearly 15 to 20% of all companies. Now, this is huge considering that we have extremely low interest rates. With interest rates so low and with high proportion of zombie companies, clearly central banks, again, need to focus where financial risks are being built. And, government, if they're going to spend more, they need to focus on where most effectively they should, because countries and companies will struggle to service their debt in the environment. I'll stop here. Thank you.
Well, thank you very much. I must say I fully share your preoccupations and your views, particularly the idea that we could have problems in challenging an inflation outburst, because we are in a double liquidity trap. Where I like to say it's not only the Keynesian liquidity trap, where it's difficult to lower interest rates, but we also have difficulty in increasing interest rates, because as soon as central banks decide that it's time to increase them a little bit, the markets will exaggerate, and this is going to be a choice between inflation and financial stability. I think it's a tremendous trap where central banks have been driving us for reasons that can be understood, but still we are in trouble in this sense. Later, let me, if I may, put myself a question, particular to Alicia. I would like to ask her opinion on China relating to her paper. I mean, to what extent the solution that she's proposing, this big institution, can help dealing with a problem that I see is an enormous one. That is the fact that China is by far the largest creditor in this business of less developed countries. Is this issue in your mind in thinking to your solution?
Thank you.
By the way, Alicia knows very well China. She's been for many years in Hong Kong, by the way.
Thank you. Yes, indeed. I think our proposal tries to fix two issues related to China's overarching role in the creditor status, meaning in having become very quickly, probably to the surprise of many, much larger than the whole Paris Club together. And the way we think the incentive structure, creating this fund will improve the incentive structure for China and the rest of the world is twofold. First, China can actually, quote unquote, hide within the creditor or the guarantors of this fund, meaning it doesn't have to be exposed to criticism, as it is the case today, of having perhaps lent too much to the emerging world, the whole idea of debt trap and so on and so forth. And by creating this fund, China could indeed be part of that community, and which in a way is a new institution. Yeah, it's not kind of China entering the Paris Club, which would be so much harder. The other side of the coin, this time around in favor of other creditors, let alone debtors, is that in exchange we would require more transparency. Yeah, I mean, for the fund to lend, the fund needs to know how much debt is out there to make sure that its lending is sustainable. And I think that again, it's like starting from scratch. I think that is quite important in terms of the incentive structure. So transparency on the one hand, secondly, China being part of a new institution, meaning not absorbing or accepting the rules of the game that are already there among official creditors.
Thank you. Yes, there is a question. I think this is a question for Akshay, but I don't understand exactly what is the point. But I think I think the problem is, okay, state-owned enterprises, multinational enterprises, but what about state-owned financial enterprises, so to speak, including funds? I mean, there's an even more powerful tool. Is there any consideration in this sense?
Typically, what happens is first of all, the state-owned financial firms are usually more transparent because the financial services, industry is better regulated. Usually, it has more international financial institutions to answer to and guidelines to follow, from BIS to IMF. Typically, they're better, they're more transparent. And what tends to happen, if you take the sovereign wealth funds, for instance, they do have their own Santiago principles, and for the most part, they're able to declare their investments and their risks quite appropriately. There are a few funds which do not. I presume the person who's asking a question, the sovereign wealth fund is a good example. If it's a pure market launched fund, then of course, all the information is already on the market infrastructure wherever the fund is based. This also happens with the bond markets or the security markets. Anything which is already on a transparent market infrastructure, we don't have a problem with. I think the problem is with the non-transparent state-owned multinational enterprises. And in the case of the US, yes, you may be right that I think it's a problem of distribution and investment, because a large part for the US foreign policy, a lot of it, the US leaves it to its private enterprises, whereas China uses and leverages the state-owned enterprises, as do some other nations. In the case of the US, they've just recently launched OPIC, as you might know, and there was some attempt that the Overseas Private Investment Corporation might transform and provide the United States with that option of now to do more equity investments and take on more risk. But I think that's still behind. I mean, it's very close to what China and other countries can do.
Thank you. Make sure you add a footnote to your paper on financial multinationals. There's a question by Artemisia Montesilvan from the Observatorio Mexicano de la Crisis. What is your opinion on the accelerated increase on asset prices and the creation of new bubbles? I think this is a question for Mehmet. Dr. Simsek.
Well, thank you. Clearly, there's a huge debate as to whether central bank can sit on the fence and watch what's happening. I mean, if you go back to a pre-global financial crisis of 2008, 2009, Fed balance sheet was less than $1 trillion. And today it is $8 trillion. Just a single, obviously one of the most significant central banks. So over the course of last year, we've had global liquidity double, global central bank balance sheet size double. Clearly, much of this filters through, financial system and ends up, we do end up with significant asset bubbles. So it is, in my view, it should be a source of worry, but also it is something that fuels, that exacerbate, that makes inequalities much worse, because those who have get much richer and those who don't, they stay behind. And now clearly this is something that, again, we cannot ignore, because inequalities lead to populism, nationalism, which itself reduces the scope for global cooperation on some of the challenging issues that we've just discussed, including, of course, impending climate disaster. So I personally think that there has to be some focus, at least, on asset bubbles that this process creates, and how, where to stop. It's very rare and it's very difficult to withdraw money. I mean, let's face it, there was never really proper tapering, even And when they began back in 2013, there was quite a bit of volatility. The problem is, as some of the earlier speakers alluded to, we've got so much debt, we just can't live with even fractionally higher interest rates. And that's like, as Professor Bruni mentioned, it's like being in a double liquidity trap. But this is not the way forward. I think the way forward is that we don't rely on quick fixes, on easy fixes. We really address some of the structural problems we face that is equally valid for emerging markets as well as for developed markets.
Thank you. My final statement is first, I thank you very much for your cooperation. And I wish the best to all the researchers that are clearly reflected in your speeches. Thank you to everybody, to the listeners, and see you soon.